CBE Practice Test 2026 Certified Business Economist Exam Questions and Certification Prep. Question 1. Which content area is not tested on the CBE exam? Applied econometrics, economic measurement, corporate law, strategy and managerial decision-making. The CBE exam focuses on economics, measurement, statistics, and managerial decision-making, not corporate law. Question 2. Which of the following indicates a strong expansion forecast regarding the term spread? Negative 60 basis points, positive 120 basis points, negative 120 basis points, 0 basis points. A positive and widening term spread, long-term rates higher than short-term, typically signals economic expansion. Question 3. In time series data, which term refers to long-term movement? Seasonal factor, random fluctuation, secular trend, cyclical variation. A secular trend represents the underlying long-term direction of the data over many years. Question 4. How is gross domestic income, GDI, calculated in relation to GDP? GDI equals GDP plus net export. GDI should theoretically equal GDP. GDI is always 10% higher than GDP. GDI only counts government spending. GDP measures output while GDI measures income, and they should be equal in a perfect accounting system. Question 5. If hours worked declined by 2% and productivity rose by 3%, what is the percent change in output? Minus 1%, 1%, 5%, 6%. Change in output equals change in hours plus change in productivity equals minus 2% plus 3% equals 1%. Question 6. Which theory suggests that business cycles are caused by real shocks like technological changes? Keynesian theory, monetarist theory, real business cycle theory, Austrian theory. Real business cycle, RBC, theory posits that cycles are driven by exogenous shocks to technology and supply. Question 7. What is the primary focus of macroeconomics in the CBE framework? Individual consumer behavior, industry-specific regulations, national income, inflation and growth, internal company cost structures. Macroeconomics deals with the economy as a whole, including aggregates like GDP and inflation. Question 8. In the AD/IS model, a decrease in interest rates would likely cause aggregate demand to shift left, aggregate demand to shift right, short-run aggregate supply to shift left, no change. Lower interest rates encourage investment and consumption, shifting the AD curve to the right. Question 9. Which of the following is a component of economic measurement? Game theory, national income and product accounts, NIPA, marketing strategy, human resources management. Economic measurement involves the quantification of economic variables, such as those found in NIPA. Question 10. What does applied econometrics typically involve? Qualitative interviews, statistical methods to analyze economic data, pure mathematical proofs, ethical philosophy. Econometrics is the application of statistical and mathematical models to test economic hypotheses. Question 11. A cyclical variation in economic data refers to day-to-day changes, movements associated with the business cycle, 2 to 10 years. Changes within a single year, example Christmas, unpredictable shocks. Cyclical variations are periodic fluctuations related to the expansion and contraction of the economy. Question 12. Which indicator is often considered a leading indicator of the business cycle? Unemployment rate, average duration of unemployment, stock prices, consumer price index. Stock prices often reflect future expectations and tend to lead the general economy. Question 13. Managerial decision-making often uses strategy to solve problems involving perfect competition only, game theory and competitive behavior, government budget deficits, global climate change. In managerial economics, strategy often involves analyzing the interactions between firms using game theory. Question 14. The law of demand states that, ceteris paribus, price and quantity demanded are positively related. Price and quantity demanded are inversely related. Income and demand are always the same. Supply always creates its own demand. The law of demand states that as price increases, quantity demanded decreases. Question 15. What is elasticity of demand? The change in supply over time. Responsiveness of quantity demanded to a change in price. The total revenue of a firm. The cost of production. Elasticity measures how much the quantity demanded changes when the price of a good changes. Question 16. In statistics and data analytics, what is a type I error? Failing to reject a false null hypothesis. Rejecting a true null hypothesis. Using the wrong dataset. A calculation error in the mean. A type I error occurs when the null hypothesis is true, but we incorrectly reject it. Question 17. What is multicollinearity in a regression model? When the error term has a mean of 0. When independent variables are highly correlated. When the dependent variable is constant. When there are too many observations. Multicollinearity occurs when two or more independent variables are linearly related, making it hard to estimate their individual effects. Question 18. Which of the following is an example of macroeconomic policy? Setting the price of milk. Open market operations by the central bank. A firm's decision to hire a new CEO. An individual's decision to save money. Macroeconomic policy includes fiscal and monetary policy, such as central bank actions. Question 19. The Consumer Price Index, CPI, is primarily used to measure economic growth, inflation, unemployment, the trade deficit. CPI measures the average change over time in the prices paid by urban consumers for a market basket of goods. Question 20. Opportunity cost is defined as the total cash outlay for an activity, the value of the next best alternative foregone, the cost of a business license, the profit made on a sale. Opportunity cost is the benefit that is missed when one alternative is chosen over another.